Hello, 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 hello. So today we are doing your a little big index, that is your index 115, that talks about revenue from contracts. So now revenue from contract, basically this entire index is split into 5 steps and we'll study each of those 5 steps. Okay. So first is your identify the contract. So basically there are 5 steps. Your first step is identify the contract. That is, there should be a contract. So how do you understand whether there is a contract or not? So an accounting contract exists when all the conditions are met. That is, all of these conditions, these 5 conditions, all of them have to be met for it to be considered as a contract. Okay. So your first one is parties have approved the contract. That means your contract is approved and are committed to perform the obligation. So the contract should be approved. Second is entity can identify each party's rights regarding the goods and services to be transferred. So first is it should be approved. Second is the rights should be easily identifiable. Third, entity can identify payment terms for goods and services to be transferred. So over here, as we understood the rights for the rights for the goods and services. So of course, in the next step, you will also have to know the payment terms for these goods and services. Next, fourth is your contract must have commercial substance. Fifth, it is probable that the entity will substantially realize all consideration. That means not just, so first is your approval. Okay. Second is identify goods and services. Third is basically your payment. Fourth is it should be of commercial nature. And last is it should be able to realize this amount of the contract. Next, two contracts would be accounted as a single contract. So two contracts would be termed as a single contract if both of these contracts are entered at the same time with the same customer. It is possible that I have entered into a contract to provide you services, as well as that is your teaching services, and also I will also give you notes. So now this is basically two contracts, but we can club it into one contract if both are entered at the same time with the same customer. Second, contract entered as a single package. That means it is a group combination. Third, price of one depends on price or performance obligation of the other. So only when I teach you will I be able to give you notes for them. So therefore, both of these are related to each other. So price of one depends on price or performance obligation of the other. And last is goods and services promised are a single performance obligation. That means even though they are separate, but they are one performance obligation only. So in such a case, two contracts will be counted as a single contract. A contract is not a contract if each party, it should not be here. A contract is not a contract if each party has unilateral enforceable right to terminate a contract without paying a substantive termination penalty. If, say, for example, I am teaching you, I take money from you, I take money from you, and I promise that I will teach you the entire FR subject. Now understand, if I have a right that I can terminate this service anytime, ki bro, from tomorrow I'm not going to teach, and there will be no penalty on me, nothing but my wish, I'm not going to teach you. So in such a case, this will not be a contract because I have unilateral enforceable right that whenever I don't want to, I will not, without paying any termination penalty. Okay. Now understanding what is your contract modification. So your step one, everything is in blue. So contract modification, we are still in step one. Okay, that is your identifier contract. So contract modification, if there is a change, change in what? Change in scope, prices, or both in a contract which is approved by both parties and is enforceable. So contract modification, that means a little change in what? Either scope, that is your scope, as is what you are offering, what services you are giving. Say for example, there was a contract to first only make a building. Now the contract has been modified that you will not only make the building, you will also do its interior decoration, you will also take part in the selling process. So now the scope of activities has increased. So there is a change in scope, prices, or both in a contract which is approved and enforceable by both the parties. Now, how do you account for such a modification? Because of course the price will change when you are changing the scope. Most probably the price will also change. Even if the price does not change, now you are paying the same price for a different scope. So you have to identify whether this modification constitutes as a separate contract or not. We have able to determine over here in this part whether it is a separate contract or not. So if the modification constitutes as a separate contract, then in such a case, treat as separate contract if both the conditions are satisfied. You will be able to treat this as a separate contract. That means accounting will be done individually, separate for both of them. If first, increase scope by adding new goods or services. That means the scope has been increased by adding itself new goods or services. And second is increase in contract price. So if both of these are satisfied, that means there is a change in scope as well and there is a change in price as well. In such a case, this will be treated as a separate contract. However, if the modification does not constitute as a separate contract, that is when new goods or services are distinct but are distinct from the original, but price is not standalone selling price. In such a case, so when the new goods or service, that the change that we have done, if the new goods and services are distinct, that means if they are different from the original, but price is not the standalone selling price, in such a case you will do prospective modification. Prospective modification means from the date of modification you will do the changes. However, if the remaining goods and services are not distinct and part of partially satisfied purchase order or not a purchase order, performance obligation. This is your performance obligation. In such a case, you will do a retrospective modification. That means this will be from the start. From the very start, you will be doing these modifications. Great. Now coming to your step 2, that is your identify the performance obligation. So first you've identified whether there is a contract or not. Now you are identifying what will be the performance obligation. So basically what is a performance obligation? A performance obligation is a promise to transfer goods or services or both. Basically you're promising that you will be performing something for them. What is a distinct performance obligation? That whether the good or service is capable of being distinct in context of the contract. That means whether they can be separated or not. In case of transfer of series of distinct goods or services that are substantially the same, treat it as a single performance obligation. Say for example, we are working in a company. Now we have entered into contract that I will be giving my services throughout the month. So this is basically series of distinct goods or services, but they are substantially the same. Every day I'm going to give the new same service. Therefore, this will not be treated as 30 individual contracts, but this will be treated as a single performance obligation. Great. Coming to your step 3, that is determining the transaction price. So you identified first was contract, second was what was second? Performance obligation. Third is determining the transaction price. So it is a consideration that the entity expects in exchange of goods or services, excluding amounts collected on behalf of third party. That means, say for example, GST is this is just an example. So any amount that you have collected on, say for example, for government you've collected. So in such a case, that will not be part of consideration. That will not be part of transaction price because this is for a third party. Transaction price is what you are paying to the party that you are dealing with. Consideration can be fixed or variable. And variable consideration, remember, variable consideration will only be included if it is highly probable that there will not be a reversal of this. That means the conditions whatever it is based on, they will most probably be satisfied. So it should be highly probable that these will not be reversed. So talking about variable consideration, so what are your examples basically of variable consideration? Say for example, your product was sold with a right of return. That means if you like the product, you use it. If you don't like the product, you can return it back to us. So in this case, it was sold with a right to return. So it is your variable consideration. Or say for example, fixed amount is promised as performance bonus at a milestone. So if there is any payment based on your performance, in such a case, this will be considered as variable consideration. And last is penalty is inherent in determination of transaction price. If penalty plays a significant part, then of course your consideration, your net consideration basically will increase or decrease because of the penalty part. So therefore, this will also be considered as a variable consideration. Okay, now what are your number of possible outcomes? So say for example, during when you're deciding the transaction price, there are two possible outcomes. If this happens, this will be the transaction price. If this happens, this will be the transaction price. So that is what we are talking about, the possible number of outcomes in terms of variable consideration. So if there are multiple possible outcomes, either this can happen, this can happen, this can happen, this can happen. In such a case, how do you calculate? How do you calculate the value of this consideration? Is you use the expected value method. Now, what is the expected value method? It is the sum of probability weight amounts in range of amounts. Say, for example, I tell you कि either A can happen, or B can happen, or C can happen, or D can happen. If A happens, I will pay you 1 lakh rupees. If B happens, I will pay you 2 lakh. If C happens, I will pay you 3 lakh. If D happens, I will pay you 4 lakh. Now, what is the probability of A, B, C, D happening? Say, for example, probability of A happening is 0.2, 0.3, 0.4, and 0.1. So, in such a case, to identify what will be my transaction amount, I will multiply each of them and then I will get a figure. This will become your expected value method. Okay, great. And next is if there are only two possible outcomes. Let me just erase this 1 second. Now, if there are only two possible outcomes, either this will happen or this will happen, then don't take a weighted average, because either this will happen or it is only two possible outcomes. So you do the most likely amount method. That means single most likely amount in range of amounts. If you have two, that either this will happen or this will happen, and this I feel has a 60% probability, and this I feel has a 40% probability. So in such a case, I will not take a weighted average of amount into probability. I will just take this amount because this is most likely to happen, that is 60%. So I will recognize the transaction price at that amount. So that is your most likely method. This is how to, at what amount to record your transaction price when there is variable consideration. Now, what are the factors that increase the likelihood of reversal? Because over here, if you realize, we were saying that include only if it is highly probable that there will be no reversal. Now, how do you determine whether there will be reversal or not? So, what are the factors? First is it is susceptible to factors outside the entity's influence. That means something that the entity cannot influence. Say, for example, some factor related to whether if this government wins or not. Now, that is something the entity cannot control. Next, uncertainty for a long period of time. If it is spread over a long period of time, of course, your uncertainty will increase. Practice of offering price concession. If it is usually noticed that you usually give a discount or you give any concessions, then in such a case, it is most probably that this time also you will be giving a discount and there will be a reversal. Next, contract with broad range of possible amounts. If there are a lot of range, a huge range, in such a case, you will not be able to determine the correct transaction price. So there is high possibility that there would be some reversal. And contract has limited predictive value. That means you are unable to predict what might happen. In such a case, very likely chance that this will reverse. Say for example, your CA result, very unpredictable. You don't know, out of 8 subjects, 1 subject might cost you. Okay, next is adjust transaction price if there is significant financing component. That means what does this mean? Say for example, you've purchased a machinery. You've purchased a machinery, say for rupees 1 lakh. You purchase the machinery today, but this payment you will be making after 3 years. Now you tell me, is 1 lakh the actual cost of machinery, or basically the machine might be actually costing 80,000 if you pay today, but because you are paying after 3 years, so this is basically an interest component of 20,000. So therefore, if there is any financing component, this 20,000 is basically your financing component. So in such a case, only 80,000 should be recorded as a revenue and 20,000 should be recorded as financing component. How do you do this? So whenever payment terms is more than 1 year, that means there is a financing component. You will have to bring the transaction value to present value using your discounting rate. Okay. So this 80,000, that is how you will be calculating. Okay. Next, in case of non-cash consideration, basically what happens if I sell one asset and in return I get another asset. So now how do I determine what will be the transaction price? So in case of a non-cash transaction, non-cash consideration, transaction price will be. So there will be two preferences. Say for example, this is my asset 1 and this is my asset 2. I am selling asset 1. This is sold and I am getting asset 2, that is receiving asset 2. In such a case, what will be my transaction price for selling this asset 1? That is what we are trying to figure out. So your first preference will be fair value of non-cash consideration. That means selling price of asset 1 will actually be fair value of asset 2. That is fair value of non-cash consideration. Our non-cash consideration is your asset 2. Your second preference, if you are unable to determine fair value of this, then your second preference will be selling price of good or service given. That means selling price of your asset 1. Great. Okay. Moving on to the next. In case your customer has provided any good or service. Now, say for example, what happens? Uh, for example, it is my mother's birthday. So I have invited someone for balloon decorations for my mother's birthday. So I asked him, ki, sir, what is the price of this decoration? So he says, ki, sir, if you buy the balloons and we only do the blowing and decorating part, then in such a case it is 100 rupees. But if we buy the balloons and we do everything, then in such a case it is 170 rupees. So basically in this 100 rupees, what am I doing? I am buying the balloons and I'm giving it to them. So customer has provided good or services. If I am providing the good or services and then they are doing their work, or say for example I'm constructing a building and I say, boss, I will buy the cement, you just do the construction part. So if the entity obtains controls on these goods or services, if the entity obtains control on the good or services, the fair value of good or services has to be added to the transaction price. In my balloon example, the entity obtained control of these balloons because they will be using these balloons to do the decoration. So therefore, fair value of this should be added. However, if the entity does not obtain control on these goods or services, then in such a case, it will not be added to the transaction price. Say, for example, the building I was constructing, I tell them, boss, I already have a mixer, the concrete mixer, I already have that. You can use it for the time being for this project for 3 months, and the life of this mixer is good 5 years. So, of course, the entity has not obtained control over this mixer. So, therefore, fair value, it will be unfair to add this. So, therefore, if the entity obtains control, fair value will be added. If the entity does not obtain control, fair value will not be added. Next, if there is any consideration payable to a customer. Now see, this is very, very weird. Usually what happens, you sell goods and services to a customer and the customer gives you consideration, that is in terms of money. But what if you have to give consideration to a customer? When does this happen? These are your examples. Basically, suppose slotting fees. So a consumer goods. So first we will do this, then first we need to understand when does this happen, because I was also very confused when I was studying this. So say for example, first is the slotting fees. That is, a consumer goods manufacturer pays retailers to have goods displayed prominently. This can be either through physical stores, ki boss, whenever the customer enters the shop, I want my good to be placed there. That is visibility. Or say for example, when you sell through Amazon, you sell through Blinkit. So I tell ki boss, whenever a customer searches for protein. I want my protein powder, my whey powder to be displayed first item. So I will be paying them for this. So therefore, this is both physical and online. So basically what happens, this service that the retailer provides to the manufacturer is not distinct. It is related to your own goods. So it is not a distinct good or service to the manufacturer, and it is a reduction from the transaction price. Okay. Next is the cooperative advertising arrangements. That is, a vendor reimburses the seller for advertisement expenses incurred by him. Of course, this is a distinct service provided at fair value and transaction price is not affected. Any price protection, that is, the vendor may agree to reimburse the retailer specified amount for shortfalls in sale price received. Say, for example, the selling price is actually 100, but I am doing a buy one get one. So basically, the retailer is only getting 50 rupees per item. So in such a case, what do? I give it back to them. So vendor may agree to reimburse seller specified amount for shortfall in sale price received. So it is not a distinct good or service to the manufacturer, and it is a reduction from the transaction price. So now you have to understand why we are understanding whether it is distinct good or service or not. So because on this it depends. Distinct good or service received from customer, is it a distinct good or service? So over here this was not a distinct good, this was also not a distinct good, only this is a distinct good. So if the answer is yes, if it is a distinct good, if it is a distinct good or service, in such a case you have to see whether consideration is greater than. If consideration is not greater than fair value of distinct good or services received, whatever consideration that you are paying, it is not greater than the fair value of the distinct good or service, then you have to account it same way as payment to a supplier. You have to show it as if you are paying a supplier. However, if the consideration that you are paying is equal to or greater than the fair value of the distinct good or service, then in such a case, excess has to be subtracted from the transaction price. If there is any excess, that will be reduced from the transaction price. Okay, therefore over here we were saying you will have to be reducing this from the transaction price. Sorry, this is for non-distinct. And balance will be the same way as the supplier payment. So only excess will be reduced from the transaction amount. Balance will be shown normal as payment to supplier. And second is if it is a not distinct good or service. If it is not distinct, then it will automatically be reduced from the transaction price. I hope this is clear to you. So basically, if you have to make a chart of this, let me erase this so that it is easier to read. Okay. So if you have to make a chart out of this, first is hmm, whether your good and service is distinct. If it is distinct, that is if answer is yes or if answer is no. If answer is yes, then again you see two parts. That is consideration not greater than fair value. That means either equal to or less than fair value. And second is if your consideration is greater than your fair value. If your consideration is less than your fair value, then this will be treated as supplier payment, normal, when you make payment to any supplier. If consideration is greater than fair value, then two parts. One is whatever excess and one is whatever is normal. Excess will be reduced from your transaction price and whatever normal will be recorded as a supplier payment. Okay. With this is your chart for this part. I hope this is clear. Okay. Now coming to your step 4. Your step 4 is allocate the transaction price to the performance obligation. First step, you identified whether there is a contract. Second step, you identified the performance obligation. Third step, you identified what will be the transaction price. Now, fourth step is basically relation of third and fourth. That means what performance obligation has what transaction price. That is, allocate the transaction price to the performance obligation. This is your fourth step. That is, allocate standalone selling price to each performance obligation, because my contract might have 3 to 4 performance obligations and I have negotiated a transaction price which is only one. So I have to identify that this transaction price, how much of the transaction price relates to which of these obligations. Because as and when my obligations are completed, I will be recognizing revenue. So therefore, it is the price at which entity would sell a promised good or service separately. That means if all of these performance obligations were not bundled, at what price would I sell these goods and services individually? Basically, you will have to identify a ratio. So basically, there are three approaches to it. Your first is your adjusted market assessment approach. Basically, you see at what price is the competitor selling, that will be, and based on if there are any changes that you are doing, then you will have to adjust it. So therefore, it is adjusted market assessment approach. What price the competitor is selling at. Second is a cost plus margin approach. That is how much cost you are taking plus whatever margin. Say for example, 10% margin you charge usually. So that will become your standalone transaction price. And third is your residual approach. That means your total transaction price minus observable selling price of other obligations. Say for example, I entered into a transaction of 1000 rupees where it had 4 performance obligations. I am unable to decide the performance obligation, that what is the transaction price to allocate to this part. So what will I do? I will do, boss, what is your standalone price? I will do what is your standalone price. I will do what is your standalone price. And 1000 minus this, minus this, minus this will become my standalone selling price for this item. That is basically your residual. Whatever is left will become for this. Discount should be allocated to all obligations proportionately, unless it is attributable to a smaller bundle of goods or services. If you are providing any discount, this has to be allocated proportionately. Proportionately to what? Proportionately to the transaction price that is allocated to them. This has to be attributed to all of them. However, if this discount can be identified to a smaller bundle of goods, then it will only be allocated to that smaller bundle of goods and services. Great. Now next is your step 5. Last part is recognize revenue when performance obligation is satisfied. How big is this? Let me see, when does this get over? Yeah. Okay. Okay. So now we are on step 5, that is recognize revenue when performance obligation is satisfied. First step was recognize contract. Second was your identify performance obligation. Third is determine transaction price. Fourth is relation between third and fourth, that is allocate the transaction price to individual performance obligations. Then next is your recognize revenue when performance obligation is satisfied. So you will have to recognize revenue when promised good or service is transferred, that is when the control is transferred to the customer. Now how do you define when control is transferred? So if the control is transferred over a period of time, that means if any of these three are satisfied, you can say that yes, the control is transferred over a period of time. What is first? When a customer simultaneously receives and consumes the benefits of the performance, he is simultaneously receiving also and getting the benefits of the performance. Second, if a performance creates or enhances an asset that the customer controls, if the service that you are providing, if the whatever you are providing, if this enhances the asset that the customer controls, it will be considered that it is done over a period of time. Or third, if the asset being created does not have alternative use to the seller, that means if I am creating any asset for a client and say for example this asset does not have any other use for me, that means if this client does not pay tomorrow, if he does not take it tomorrow, I will not be able to sell it to anybody else. it does not have any alternative use to the seller. I am the seller. Then in such a case, it is done ki boss, control is being transferred to the customer. Now, how do you measure the progress? Progress measurement can be done using either of the two methods, either output based or input based. That means either what is coming out, what is your finished product, or what input you are putting. If anything requires 1000 kgs and I've put already 300 kgs, that means 30% progress has been made. This is your input based. Output based will be what? Say for example, I'm making a building of 10 floors and I have already made 4 floors. That means 40% because this is my output. So progress is 40%. Next is transfer of control at a point of time. If none of the above criteria are met, then it is done at point of time. So either any of these three. If neither of these three, then it is done at a point of time. Next, when an entity acts as a principal, recognize revenue on gross basis. That means, say for example, I am running a business of, say for example, spices, and I have a agent in Amritsar who sells these on my behalf. He takes a 20% margin and gives me only 80% of the amount. So in such a case, do I recognize my revenue? Is my revenue 80% or is my revenue full 100%? That is what the question is. So they say ki when you are a principal, recognize revenue on gross basis. That means your entire 100 will be your revenue. However, the agent will recognize revenue on net basis. That means this 20% is only the agent's revenue. Only this 20% is what the agent will show as revenue in his books. Okay, next. When customers are given option to purchase goods or services by way of coupons, loyalty or reward programs, say for example, you take a credit card and they say ki boss, for every 100 rupees you spend, we will give you 1 rupees and this 1 rupee you can spend later. So in such a case, revenue is recognized when the future good or services are transferred or when the option expires. Only this revenue will be recognized only when the good or services are actually transferred. Say for example, I have a furniture shop. Today you bought some amount and I tell you, boss, next time when you come, I will give you 10% off. Or instead of 10%, let me give you a more better example. Next time when you come and if you shop more than 10,000 rupees, I will give you a free chair. In this case, I have given you a coupon. So this revenue will only be recognized when the goods and services are actually transferred. That means later when you actually come and buy for 10,000 rupees and when I give you the free chair, only then will I recognize this as revenue. Great. Next is sale with the right of return. Only recognize revenue. That means when you are selling and when the party has an option to return the product to you. Only recognize revenue for products not expected to be returned. Only if you feel it will not be returned, only then. Say for example, there's some customer which is very choosy and you know ki boss, he returns 80% of the products, then in such a case do not recognize your revenue because you think that yes, most probably he will be returning it. Recognize refund liability for goods expected to be returned. That means there will be a refund liability, you'll have to refund them. So this you will recognize. Restocking fees for goods expected to be returned would be recorded as revenue when control of good is transferred. That means restocking fees, sometimes you charge your customers for refunds, for returns. That boss, I will have to get this good back from you and restock it in my warehouse. This will charge me additional money. I will charge you for this. I will charge you restocking fees. So the question is, sir, should I charge this restocking fees as revenue right now? Answer is no. Restocking fees are expected to be returned would be recorded as revenue only when control of good transfer. That means only and only when you receive the control of goods back, only then will you be charging this as revenue. Example, there's a contract to sell 10 units at rupees 100 each. That is total what? 1000. Customer has option to return at 3 rupees per unit. This 3 rupees is your restocking fees. entity estimates that 10% of the units will be returned. When we say 10% of the units, basically out of 10 units, it feels one will be returned and 9 will be kept. So in such a case, recognize revenue of 9 units at 100 rupees plus 1 unit into 3 rupees your restocking fee. So your comes to 903 rupees. And your refund liability, will you be refunding full 100 rupees? No, because you will be cutting 3 rupees for restocking fees. So 100 minus 3 rupees, 97 rupees will become your refund liability. Great. Next. Next is your warranty. So when a customer has an option to purchase warranty separately, that means you buy a laptop and they say, ki, sir, you have an option to buy an extended warranty for 3 years. So basically the customer has an option to purchase the warranty. He may or may not. Then this is a separate performance obligation and portion of the transaction price to be allotted. However, if the customer does not have such an option, then the entire revenue attributable to the product. Okay. Next, in case of bill and hold, customer is billed, but the physical possession remains with the entity on customer's request. Say, for example, I want to purchase a horse. So what do I tell them? Ki, boss, you keep the horse. I will come in 10 days and I will take the horse. For now, you bill me. So you've already billed, but the physical possession of the horse is with you. Customer is billed, but the physical possession remains with the entity on customer's. Entity is basically the seller. The product must be identifiable separately because I have specified ki, boss, I want this horse. Therefore, this is a separately identifiable product. I have not told them ki, boss, I just want a fridge because fridges are replaceable. I can take any of the 10 fridges of the same brand, same specification, same model, everything. But a horse is a specific, it is separately identifiable and it is ready for physical transfer. So because I have told them ki, boss, I want this horse, you keep this horse, I will take this horse, but later. So therefore, you will be able to recognize revenue. But if the customer tells ki, boss, I like this fridge, you bill me, but I will come take it later. You will not be recognizing a revenue because it is not separately identifiable. My horse was separately identifiable because I want only this horse. If tomorrow this horse dies, I cannot take another horse because control has actually been transferred, just physical possession is with the person. Therefore, because the control is transferred, revenue can be recognized. Okay. Okay. Now coming to your last part of this chapter is sale and repurchase. What happens in sale and repurchase? I sell you an asset and then I again buy it back from you. Say for example, I have an asset. What asset do I have? Say for example, I have this glass with me. Okay. I sell this glass to you for 100 rupees and then I buy this glass back from you at 150 rupees. Why would I do this? Basically, I have provided you with a finance of 50 rupees. So in such a case, when the entity sells goods and promises or has the option to repurchase the goods, I have first sold and then I have an option to buy this later whenever. So if the repurchase price is equal to, if the repurchase price is greater or equal than the original selling price, say for example, my original selling price is rupees 100. If the repurchase price is rupees, oh, we have an example. Okay, we'll do that only. Original selling price is 10 lakh and repurchase price is 11 lakhs. In such a case, your financial liability is only 10 lakh and 1 lakh is your financial cost. This basically you are paying the boss, I will buy it later from you. And this because of later, it is basically 1 lakh. You sold it for 10 lakh, but later you'll be buying it by for 11 lakh. This means you have actually received 10 lakhs and you are going to repay 11 lakh. Doesn't this sound like a loan? Okay, today you borrow 10 lakh from the bank and tomorrow you will, and after 1 year you will pay them 11 lakh. So basically that 1 lakh is what? Nothing but interest. So therefore 1 lakh is your financial cost. When the repurchase price is less than the original selling price, that means your original selling price is 10 lakhs and repurchase is only for 9 lakhs. So basically you have earned an income of 1 lakh. How? Basically you give them an asset and you got 10 lakh rupees. And after 1 year, they will give this asset back to you and they will give you 9 lakh rupees. Sorry, you will give them 9 lakh rupees. Basically what happened? You gave them an asset and earned 1 lakh rupees. So don't you think this 1 lakh rupees is basically rent for the asset? So therefore it is your lease income over the period of lease. Understandable? Easy? Very logical. Next is licenses of intellectual property. Any intellectual property ka license. So if there is a right to access the IP over time, say for example, there is a producer of toys and he takes IP rights from the producer of Shinchan to make a toy. In such a case, revenue will be recognized over time, provided all conditions are met. That is, entity is required to undertake activity that affect licensed in IP. Say for example, I am the creator of Shinchan and there is an entity in India that wants to use my character, my Shinchan character to make toys. So I will sell them these IP rights and I will charge them for this. So if me as an entity, if I am required to undertake activities that affect the licensed IP, that means what brand image I create of Shinchan will also affect his sales. So therefore I am required to undertake some activities. Next, license exposes customer to any effects of entity's activities. Whatever I do, it will also affect my customer. And third, entity's activities are not a performance obligation in contract. It is not mentioned in the contract that boss, I have to release new episodes of Shinchan or something. These are not performance obligations. If all of these conditions are met, we can define that yes, revenue is done over time and there is a right to access IP. Next is right to use IP, that is at a point of time. So revenue will also be recognized at point of time. If all three conditions are not met, it will become at point of time. Otherwise, it will be met over a period of time. And with this, we are done with this chapter and I will see you in the next one.